welcome and thank you for joining. My name is Craig McInnes, co-CEO at myCaribou, and I'll be hosting the session today. For those of you that aren't familiar with us, our platform is the only global medtech platform for helping manufacturers and distributors accelerate growth through stronger partnerships. We do that by helping you to discover medical device market insights in over 105 countries around the world, helping you to build new partnerships by connecting you with over 43,000 manufacturers and distributors in 150 countries, and through a set of tools that allow you to manage global partnerships, improve your communication, and monitor performance all over the world. You can sign up for free. There is a link. I think Angela will probably put that into the chat here today as well, so you have access to it. So we are going to be focusing today on exploring the current economic environment and how it's affecting M&A activity in this industry, including acquisition timelines, processes, and valuation models. So let me introduce you to an amazing panel. I'm really thrilled to have these three gentlemen join me today. So we're going to start with Brett Valiant, who's the VP Corporate Development at Diploma PLC. Brett has led corporate development focused on M&A for Diploma PLC's global life sciences sector for 3.5 years. He formerly ran one of Diploma's businesses, focused on value-added distribution in the endoscopy and minimally invasive surgical space. For almost 20 years, Brett has worked with a range of technology leaders in clinically specialized segments and is experienced with all phases of product commercialization across various geographical markets, including Europe, North America, and Australasia. Second, we have Rainer Hepberger, Managing Director with Houlihan Lokey's Healthcare Group. Rainer has more than 15 years of industry experience in medical technology, healthcare distribution, outsourcing, and consumer health. During his career, Mr. Hepberger has advised on more than 50 M&A transactions across Benelux, DACH, the UK, Scandinavia, Spain, and Israel. He's based in the firm's London office. Prior to joining his firm, Mr. Hepberger spent 9 years at William Blair, most recently as a managing director in European healthcare investment banking. And between 2018 and 2020, he was a managing director of Raymond James, their healthcare team based in Munich. And also held roles at PwC and MWT. And then lastly, we have David Brangham, partner with Simmons & Simmons, based in Dublin. David is head of the corporate M&A team and advises a wide range of corporate matters with his experience, including foreign direct investment, M&A, private equity transactions, joint ventures, venture capital investments, and corporate reorganizations. David has expertise in the healthcare and life sciences sector, including advising on some of the largest and most high-profile corporate transactions in Ireland for a diverse range of US and European clients. So you can see why I was so excited to have this panel. A lot of great depth and experience from the corporate side, from the investment banking side, from the legal side, and really thrilled to have them here today. So Brett, Rainer, David, thank you so much for joining. So we're going to start with a pretty high-level question. It's been an interesting, obviously, several years we've all been through. And I'm curious, and with maybe Brett starting on this one, what your thoughts are on the current economic environment and the impact on mergers and acquisitions in medtech.
Sure, thanks, Craig, and thanks for having us on. Really interesting environment, to say the least. It's been a roller coaster over the last few years. I think right now there's, we're highlighted by uncertainty. You see things typically slow down in times of volatility. So right now we've got fear of global recession, what appears to be persistently high interest rates, compounded by a war in Ukraine, some further geopolitical tension in the Far East. But interestingly, I was just at a private equity conference in Miami yesterday, and the interest in healthcare persists. PwC reported that although deals are down from record highs in 2021 and 2020, they're still well above pre-pandemic levels. So it's still a good time for transactions. We hear a lot of talk about, a reset in valuations, maybe multiples that are returning to more attractive levels. But in healthcare, I'm not so sure that we're seeing that level of pullback. In fact, I think the perceived break in high prices has caused accelerated interest in high quality assets, specifically in defensive industry like healthcare. So I think, business owners on the call, they might take comfort in knowing that, consolidation and buying really hasn't slowed down. And if it has, it won't have slowed down for long. I think that same PwC poll said that 60% of healthcare executives say they have no intention of slowing down their M&A activity. So, the key for buyers like us is to have a well-defined strategy and stay the course.
No, Brett, I think I fully agree with you. I think the current environment is extremely challenging. Inflation, interest rates, financing, war, as you mentioned the key points. So that has certainly an impact on the overall M&A market, but specifically on the Medtech market, volume is down, but we are coming from an extremely high level. So the pre-pandemic and then also during the pandemic, the deal activity was extremely high. And so it is a little bit of a normalization. Then I would say like a big downturn in M&A activity. I think what we see specifically in Medtech deals at the moment is that because of these macro challenges, it's more difficult to get deals over the goal line. It takes longer, deals take longer. I think the points we'll discuss a bit later, they are even more important, like things like preparation and get the right buyer universe. So yes, I think Q4 everyone was extremely worried, but now things are picking up as well. I think over the last couple of weeks we've seen a lot of pitch activity at our end, and we see more optimism than before. And I think one point Brett made, and I really want to highlight that Medtech and healthcare is a resilient sector. And if one of my consumer colleagues or industrial colleagues would sit here, I think the outlook would be different.
And I fully agree with that, René. I think you're right in that that's certainly what we would have seen as well, and that boom that there was in Medtech transactions was something of a mutation away from the norm. And I guess a lot of that was driven as well when we came out of COVID and the activity that we saw there. So I think what we're seeing is a return to normalized, sustainable levels, which is a good thing, I believe, in the longer term. By the same token, I think you're right in that we're definitely seeing transactions take longer to get done. They're becoming more complex in themselves for reasons we'll touch on later. We're also seeing variations in terms of consideration structures and things like that, which just make it all that little bit more complex. And I think all of the reasons we've talked about as well have fed into that taking a bit longer, in the sense of deal makers are, particularly buyers, that naturally more conservative. People not wanting to go to investment committee until they're absolutely sure in something. Diligence taking longer than it would otherwise, and all sorts of other aspects as well, just taking that little bit longer, particularly where people are dealing with third parties and getting borrowing from banks and all of that kind of thing. It's taking longer than it did before, and that's all folding in to a more elongated transactional process. But by the same token, as I say, and agree with both Brett and René on, there's still the volume of deals there. They're just taking longer to get done.
Great. So let's dig in a little bit further on this then. So if we think in terms of medtech acquisitions and mergers today, what are some of the key trends and characteristics you're seeing in recent transactions? And this time we'll start with Rainer.
Sure. So I think the first point that's a really important one, the long-term trend is intact. It's a defensive industry. We see a lot of super exciting technological developments. A lot of innovation in the sector, and the sector has attractive margins. Absolutely, when you look at it more from a macro picture, the medtech industry still has very, very attractive margins, and this will drive M&A. And like also the slowdown in some other sectors will put more focus on the medtech industry. So the long-term trend is there. In the short term, there are some uncertainties in transactions that we are working on, and that we see there are very aggressive tender strategies, very aggressive GPOs out there, and increasing also market share of some chains. So you see an increasing focus on costs. That's a due diligence item that is getting more and more important. Also, on the inflation side, it's not always possible to pass through the increased costs to the hospitals, to the end users. That has certainly also an impact on margins. But we see that already a bit improving. But that's a fact. I think specifically on the appetite for some of the corporates, declining share prices never help. But let's keep in mind, the large consolidators, they have a lot of cash available. They are looking for innovation, for innovative products that they can buy. And that's now actually even more relevant because the IPO window is pretty much closed. And the large consolidators are aware of that and are actively looking into that. I think other things we'll see, private equity is a bit less active. Financing costs are very, very high. You'll see that. So the traditional private equity backstop you have in a transaction is maybe not there anymore at the moment. So it's more focused around corporates and strategic acquirers. I think in terms of deal size, everything below 100 million transaction volume, enterprise value, we don't see a massive impact at all. These transactions are usually driven by tech, by IP, by getting new technologies on board or getting a niche segment covered. Everything that is above $1 billion is very tough for the reasons that I mentioned. The financings are not available or very difficult to get. Everything in the middle between 100 million and $1 billion, that's depends. I think it depends a little bit on the sub-vertical and the sub-sector, on the type of deal. But I think overall, yes, there are clouds, but we still see very, very solid activity and interest for high quality companies. And I think the flight to quality is more relevant than ever. So high quality assets attract high multiples and a lot of interest.
And I think, Reynard, I fully agree. And I think building on that as well, I mean, one of the big trends we're seeing as a result being built into transactions, just with the uncertainty and so forth that's there, is earnouts. And I guess a lot of that's driven by, I suppose, two sources of the need to find normalized financials on businesses, in that obviously for whatever it would have been 18 months to 2 years, everything was completely disrupted by COVID. So trying to discern what a company's normal trading was like was very difficult. We then had this boom period for, a year after COVID, which again was skewed. So Dealmakers are very much struggling to try and actually work out, well, hold on, how is this company performing at this point in time? Because we have, a 3-year lacuna, if you like, where we can't really judge how things are. So we're seeing a massive increase in the use of earnouts in varying shapes and forms. And, those have their complexities as well. And I think increasingly, that's probably one of the other reasons why we're seeing less of the private equity activity, which Rainer mentioned, because private equity is less inclined to want to do earnouts. They want nice, clean exits, whereas obviously trade buyers are that little bit more flexible in terms of what they can do as well. So I think that's probably one of the major trends which we're seeing. I think in terms of activity and sub-trends, I completely agree with what Rainer said in terms of the tech element being the dominant partner in the relationship, if you like. And we're even seeing that in terms of, I think, the positives that came out of COVID in the shape of, the ability of all of the various healthcare systems around the world to adopt technology very, very rapidly. I think that's been recognized. And there's almost now driven as much by the public as the private space, that need and that push for more medtech. And, we're even seeing that more in terms of, telemedicine, things like that, increasingly as a result of health services not wanting to have patients in hospitals for as long as possible. The deployment and use of medtech that enables patients to monitor and in some cases treat their own conditions more effectively at home. And I think, all of those things coming together are keeping that deal flow going. I think the other thing which we're seeing as a challenge, and I think a trend on deals which companies are struggling sometimes to demonstrate, is around that supply chain piece. I think in the last 3 years, a lot of companies kind of got by with it in terms of medtech supply, but and healthcare services were happy to sort of take a just-in-time approach. Whereas I think as we kind of go forwards, they're going to want to see a better certainty in terms of delivery of critical products and things like that.
Hey, David, on the earnout piece that you mentioned, I sold a healthcare-focused technology company back around 2015 with a 2-year earnout period. Is the 2-year earnout, is that expanding longer? Given your comments earlier, are you seeing 3 or 4 year earnout periods, and what are some considerations maybe around that as well?
Yeah, no, that's a really good point, Craig. I think we're seeing it done in a variety of ways. I think in terms of the timeframes, probably a year is the shortest we're seeing, and then we're seeing up to 3 or 4 years in some instances. And it obviously being done in multiple tranches and multiple payouts over a period of time, very often linked to EBITDA or other sales performance over the period of that time. In some instances, linked to renewal of key customer contracts and things like that, which is something we'll talk to in due course as well. But certainly, I think it's fair to say that the timeframes are increasing and they are becoming more plentiful. And I think it's just reflective of, I think, the shift that there's been in the last 12 months or 12 to 15 months away from that very, very seller-friendly market that we've seen to one which is more leaning towards the buyer. There has been that shift in the tide.
And Brett, any thoughts on the trends and characteristics in general here?
Well, when we look at medical device, medtech, and that could include, diagnostics, IVD, even lab to a certain extent, generally most segments are growing between 3 and 5%. And you can put your finger in the air and say some might be 6, some might be 2, but generally between 3 and 5%. So if you've got a business that's outpacing that significantly, it's going to be really, really attractive. I mean, we talk about coming out of this era of uncertainty. If you were catering to elective procedures, you might have gotten beaten up through COVID. Conversely, if you're a diagnostics company, you maybe did very, very well through COVID. But I think most investors, whether that's corporate investors representing shareholders or it's sponsors looking to invest capital, they're looking for stability. There's no sure bets out there, but accretive businesses that are growing at north of 5% are going to be really, really attractive. And sometimes those businesses may not be that big. So we hear that 2023, maybe even to 2024, may be the year of the bolt-on, right? Where companies might not be placing massive bets and buying new platform organizations, but they'll be looking for synergistic businesses that complement their current portfolio. I also think the point that David made about technology that enables sort of decreased cost is really, really important. A lot of governments or other payers are under a massive margin crunch right now. It's been really expensive to weather that COVID storm, and they've got to recoup some costs. And so they're looking at technologies that can help bring down their spend to some extent. So, the Me Too stuff may not be that attractive, but if it's innovative and if there's a funding mechanism in place, it's getting a lot of attention. And right now that typically leans towards tech.
Great. So let's move into the process side of this. As I mentioned, I haven't gone through with this myself. Know that it is for owners and operators of businesses that are going through this process. It is a massive, time-consuming process that can kind of consume you along the way. So we've got a few questions we want to focus on here. One of which is, if you've gone through this process, you realize afterwards there's some things you could have done in advance, perhaps years in advance in some cases, to help prepare your business for an eventual sale. So I think on this one, let's start with David.
Sure, Craig. I think the easiest way of thinking of it is almost to reverse engineer it and put yourself in the shoes of the buyer and say, well, what, if you were buying it, what would you want to see? And so when you break it down like that in terms of diligence, as between, say, the various functions that you'll have, so financial, tax, legal, operation, technical, and it's really that exercise being done well in advance of collating in as clear a way as possible all of the various strands that will fold into each of those and keeping them in that order. I mean, obviously in due course, when you start a process, you'll open a data room and so forth, but even starting to pull together all those documents, customer contracts, having them all. And as you're doing that process for each of them, whether it's your financials, whether it's your legals, all of the kind of customer contracts, that kind of thing, using that as almost an audit to say, well, actually, hold on, we spotted a gap there. We haven't got that contract signed by them, or actually, oh, look, this one's expiring next year, because that will allow you to then try and get out in front of those things before they're picked up on any sale process. And I think, I know we'll talk about deal process and so forth a little bit more, but I think particularly say in terms of financials, what we're increasingly seeing now is with transactions taking a little bit longer, with the pressure being off buyers as a result of it being more of a buyer's market, they're increasingly doing their financial diligence first. So first and foremost, they will pour through the figures, try and ascertain that normal trading, that normalized EBITDA, all of that kind of stuff first. So I think if you were to prioritize, it's probably in that financial strand to make sure that all of your I's are dotted and your T's crossed within that. Legal in terms of, customer contracts. In terms of, I think as well, it has to be said, key employees, are they all kind of signed up? Are they locked up in terms of non-competes, all of that good stuff? And just using it as that audit function yourself with the benefit of a little bit of time to fill any gaps.
Rainer, any thoughts on this?
Yeah, I think preparation is key of a process. And please excuse the pub slang, but you don't want to be the guy who shows up to a gunfight with a knife. So preparation is of utmost importance for a successful M&A deal. And Craig, as you said, it's a lot of work. So you may consider maybe to have a business development, corporate development function in the organization that helps with the process, someone internally that is dedicated to the process. What is very important, like building a financial model, price volume in Medtech specifically is extremely important. Think about like your CFO, how strong he is. Is he able to, work with multiple parties in the diligence work streams? And then also, like, what's the management situation? Have you thought about succession? When you are the owner of a business, you want to retire? Do you have a successor in place, someone who can take it over? These are all very important points, but really spend the time on preparation and keep then the process as short and swift as possible.
Yeah, I think as we alluded to there, starting the work now, even if you don't intend on selling or being in that mode for a few years, doing the work now in advance, getting set up for that is critical. I know I learned that through our process. So let's the second part of this then. The second part of this question is around how long the process typically takes. I know it's one of the first questions people tend to ask when they're working with investment bankers in particular is, what's the process going to look like, but also how long is it going to take. So on this one, Brett, do you want to start from the corporate side as you do these deals? What's the typical process timeline?
Yeah, it's a great question. I mean, it's usually 2 to 4 months. Of course, there's a lot of buts to that, right? It could take anywhere from 1 month to 2 years, quite frankly. So, in an auction process where it's being run by a group like Wilhelm Loki, Rainer's team, or they're doing a targeted solicitation, where they're going out to certain prospective buyers that they know might be a good fit. That's going to be a little bit more time compressed. Obviously, and there's an expectation that these buyers who have been contacted can work through diligence, in 30 to 60 days. In that scenario, of course, a lot of the pre-work has already been done. So there's already vendor due diligence reports, financial, commercial, legal, etc., available to the prospective buyer. In that situation, you can run pretty quickly. If it's a smaller business and they might be working with a smaller intermediary and they're not quite as organized, that's when it can take some time, because there's a lot of things that don't get considered. And yeah, that's where deals can fall down. And I think we're going to touch on that a little bit later on in the talk.
Rainer, thoughts on this?
Yeah, I think from a seller's point of view, and we usually work for sellers, it's a bit longer. So I would say usually 6 months, 8 months. As I mentioned before, take the time for the preparation. You have as much time as you want in the preparation, but keep the time where you're in the market as short as possible. It's a disruptive process to the organization, to the business. There are market rumors. Yeah, you can sign as many NDAs you want. It will leak at some point somewhere. And then you have to deal with questions from suppliers, from employees. So keep the actual process as short as possible, but take as much time as you need for preparation.
And as a follow-on, I'm going to actually just ask Rainer to expand on this, because we got into a conversation in preparing for today's presentation, but about the breadth of the process and how to evaluate and select the appropriate buyer. So Rainer, I'll just ask you to kind of expand on that part of what Brett started to talk about. And auction.
It depends on a case-by-case basis. I think I worked last year in a company that was a one-off and it worked perfectly. It was a super complex deal where actually there was maybe only one buyer that could buy this company. Well, it could make a lot of sense to do a one-off. It could also make sense where you absolutely have no idea who would buy this company, to do a very, very broad auction. In most cases, it makes most sense to have a so-called targeted auction. So where you basically work with your advisors to define a list of potential buyers. You may want to exclude some competitors you don't like, and then really work together on the list. What is really key? I think that's the one takeaway from my point of view that is important from this. From my end, is the private M&A market is not an efficient market. You're not looking for the market equilibrium. So you need to get a bit of a process going. You need to get competition going to not find the market equilibrium. You're as a seller, you're not interested in what's the right price for my company. You're interested in the party that pays the highest price. And so I always see owners coming with a 100-page valuation deck from their auditor saying, oh, this is the value of my company. Yeah, well, maybe not. Maybe at the end of the day, it could be like 200-300% higher, but it could also be half of what's in the 100-page document. The private M&A market is the search for the outlier valuation and for the party that is paying the highest price and gives you the highest value and the best terms, the best package.
Excellent. So let's talk a little bit about the due diligence process, which is, again, having gone through it myself, it is an enormous undertaking. So why don't we start, maybe Brett, just comment, again, you're acquiring companies. So what's involved in the due diligence process? And then maybe, David, if you could kind of chime in as well on that would be great.
Yeah, I mean, I think David chunked it out earlier. Really, the components are commercial, financial, legal, tax, environmental, and it's ultimately in that order. I think we can get a fairly good view on finances pretty quickly if the books are in order, right? If the management accounts are fairly consistent with what we've seen in reported earnings, and there's no major adjustments. And by the way, if you're going to make lots of adjustments up, meaning you're going to show a better P&L than what may have actually been produced in the past, you should probably also show some realistic adjustments down just to maintain credibility. But that's financial gives us the confidence to proceed with commercial, where we take a look at the market that companies are operating in, what their competitive position might be, and then we get into the details where we're calling folks like David to help us through legal.
And I think as well, then, just to sort of maybe build on that a little bit in terms of that process, and as you'll have sort of seen and appreciate, Craig, it very much is an iterative back and forth process in that obviously the buyer will be doing their diligence, and all being well, a nice pack of information is available that will be given to them. But it then does become very much a case of them asking further questions and trying to get as clear a picture as possible. And that's done both for their own benefit. I think it's also worth noting on this call as well that can also be done for the benefit of their insurers, because very often on transactions, the buyer is taking out insurance to cover any risk. And as you can appreciate with insurers, they like to tick boxes, and so they need lots of information to be able to do that. So it does become, as Craig mentioned at the start, a fairly all-consuming process. And I think, the advice to those on this call would very much be to, as best you can, put your advisors to work on that in order to shield you as far as possible from that process, to ensure that you still have enough bandwidth to actually do the day job. And I think that does tie in with the very, very first point that we made on this query in terms of preparing for sale. And as Rainer said, it's all about preparation. And if you do that volume of work up front with the benefit of time and a little bit less pressure, then it does pay dividends in the longer run, and hopefully it will result in a faster diligence process, and one in which you're getting disturbed less than would be normal on further queries and things like that from buyers and their advisors.
Yeah, we're going to touch on the roles of investment bankers and legal advisors as part of this process. And having gone through it, yes, it costs money, but it is absolutely worth it. And you do want to put them to work because you still have a business to run. Okay, so let's move into some of the common risks. So what are some of the common risks or factors that can lead to deal failure, and how can companies mitigate these risks to increase the likelihood of a successful transaction? So let's start here with Rainer. Sure.
There are things you cannot avoid, like big macro events, wars, pandemics, whatever. It's just very, very difficult to plan ahead. I think the tools we discussed can be used to mitigate that, but that's sometimes difficult. What also happens sometimes that your major competitor decides instead of, or your large consolidator decides instead of buying the company, also filing a IP lawsuit. That happened in the past. That has probably zero chance to be successful, but the process is off. Buyers are worried, you cannot explain that to their boards, to their committees anymore. So this can happen. So things you cannot avoid, sometimes things happen and process fail. But there are a lot of things you can avoid. And I think the one really important point is thinking about your current trading. And when you put the materials together, you put your business plan together, you show your budget in the materials. And when you go to market and it's like impossible to hit the current year budget, that's a recipe for disaster. This doesn't work. Like when I work on the buy side, I see very, very often outdated financial models where just people didn't want to spend more time in updating them and just let's go to market. We've spent so much time and money already. That's a big mistake. Also, one point I see a lot, and that's a little bit of a healthcare specific topic, is like people are constantly in the market. Like they don't run a structured process, and when it's not successful, then okay, let's regroup and let's figure out how can we make this successful in maybe 1, 2, 3 years. But people that are constantly in the market, it's very, very, people get bored. And it's a bit like dating. You need to be difficult to get and not constantly in the market. And I think on the other points that we discussed, the better you prepare, the more likely you'll face major challenges. And I think the last point, be realistic about the valuation expectations you may have, and also be careful when you enter a process. And that goes both ways. Too high or too low, that you make sure you know what is realistic and what's not realistic. And I think sometimes to be overly aggressive can actually lead to a failure. On the other hand, if you're like far too conservative, you end up with a valuation that is not so effective. So keep that in mind. Realism is very important here.
And I think then, just from a more of a legal perspective than anything else, there's probably, I suppose, 3 things that we see that don't necessarily cause deals to fail, but in some instances, when they're particularly material, can, but more often than not, just lead to a little bit of turbulence on the deal itself. And I guess those things would be, firstly, any customer, third-party consents that are needed for the change of control of the business. I mean, that's the most common one. The other one, and which we've seen sort of kill deals, is where there's certain arrangements with key customers that are coming to an end and they haven't been extended. And then the other one as well, which I think we've touched on already also, is just around key employees and there not being robust arrangements in place with them or around the ownership of IP that they might have created. And I think all 3 of those things very much do kind of circle back on that preparation point that Rainer mentioned as being absolutely key, because it is at the start of the process where you can look at these things down the track and see, well, actually, as you sort of look over at the horizon, you can see where they're going to come up and try and fix them at that point in time as best you can. So knowing where there's going to be a key customer that you're going to have to get their consent for, that a buyer's going to want, and building that, obviously you can't go out and get it in advance, but building the rapport there such that it's never going to be an issue, or where there is short-term arrangements for the key customer, looking to get those extended as best as possible, equally with employees and things like that, putting in place those arrangements, ownership of IP, making sure everything's registered. So it definitely all comes back to that preparation point.
And Brett, Diploma, obviously you're out there acquiring companies. Really curious in your thoughts on this. What are those risks and factors that can lead to deal failure from your side of things?
I think for the most part, the key ones have been touched on, right? Outsized expectations in terms of valuation, but that's something that you're going to figure out typically at the outset. Where deals fall down later into the cycle is often it's around change of control. And, for the smaller distributors out there, there's a tendency, and I represented a smaller distributor for many years of my career, and I was probably guilty too of overestimating my relationship and my sway or influence with that supplier. And the reality is, some of these corporations are very big and there's layers of bureaucracy. And to get that change of control can be really difficult, especially if you're selling to, private equity. They may not like that. They may not like the strategic buyer because there could be portfolio conflicts in other regions. And so really think that one through. And it's tough because, you don't know how early to bring in your suppliers, right? This might not be something that you're messaging with your suppliers until you're fairly confident that you're going to get a deal done. But at that stage too, there's a lot of momentum. And so it's very much nuanced, but it should be an open discussion with the banker, with the lawyers, and with the prospective buyer from the outset.
Excellent. Yeah, it's a as I say, it commits so much time to the process, and and that the efforts you put in, and deal failure is painful on both sides of the equation. So, all right, let's move into valuations, which is an area that often comes up as one of the first questions, and we've touched on it a little bit so far. But what are the key drivers for valuations? And I think we'll start with Brett on this one, as somebody who's acquiring businesses.
Yeah, and my list can be quick and efficient. So, an attractive portfolio that's in specialized segments. There are a lot of buyers out there that are looking for market share, more of a commodity play. For us, we're looking for, specialized products and technologies. You want to have really sticky supplier and customer relationships. And by sticky, you can demonstrate them, whether it's through contract or through a history of success, stable and consistent growth. So a P&L that's not all over the place, and good gross margin. I mean, most businesses that we look at require 20 to 25% of the proceeds from their sales go back into their OPEX. And so if your gross margins are falling, below 30%, it gets very lean at times. So healthy gross margin profile with minimal degradation over time. And of course, I think David touched on it earlier, strong leadership team that can be transferred over.
Rainer, on the investment banking side, I'm sure it's like question 1 or 2 that people tend to ask you, right, when they engage with your firm.
Yes, of course. It's the key question, and then there are, like, as I said, 10, 15 different types of models you can run. And as I said before, I think competition is usually driving valuation. When sometimes, like, 2 strategic buyers meet at the airport by coincidence, and then they know, okay, in a remote place, okay, the other one was also at that company, that can help. This will certainly drive valuation. In the current market, think about your COVID impact, and how to show and present that one, and also as a buyer, how to think about that, because there is still a lot of noise in these numbers. EBITDA margins nowadays also very extremely important, given the cost increases you see. Cash conversion is always a very important topic, and also what are the capex requirements of the business. That's also always important. It really comes down to the cash and margin stability at the moment.
David, any thoughts on this one?
No, I mean, I think Rainer and Brett have captured everything, and certainly it's always best for lawyers to stay away from numbers. So I think the guys have probably covered all the bases that I would.
Okay, so let's get into so we today, obviously, just if you joined sort of late and didn't get the bio, the intro. So Brett's company, Diploma, is acquiring is in the acquiring companies, I should say. Rainer is on the investment banking side, and David is on the legal advising side. So we're going to dig into that a little bit, because again, I've gone through this process, engaged both an investment banker and a legal advisor. Both were absolutely critical to the process. So what are some of the key considerations and factors that companies should consider when hiring an advisor or investment bank to guide them through the formal process? The obvious first choice here is Rainer.
Okay, no, it's always an interesting question. What I hear most, and what is really important, is alignment of interest. So if you are an owner of a business and you hire an investment bank, you want the interest fully aligned. That means when you smile as an owner, you want the investment banker to laugh. So when you laugh, sorry, that's bad. The joke didn't work. When you are an owner and you laugh, you want your banker to smile. So alignment of interest and the incentives is extremely important. I don't take on any mandate where I would need a retainer. I take only mandates on where I feel so comfortable that the deal is happening that I can work on a success fee only basis. And as soon as someone is pushing hard for a retainer, I would get worried. There are people out there that live from retainers. So success fee focused model is extremely important. The other thing that is important, experience in the sector, knowledge of the buyer universe. Do they really, is the bank really knowing the buyers? Do they have access to the right people? That's important. And then the team, the people. It's a people's business. You spend a lot of time with your banker over the next 6 months, 9 months. And you want to get to know them, and you want to not only get to know the senior guy who shows up at the pitch and will tell you, of course, great war stories, but you also want to meet the junior guys. They spend a lot of time with you. They are very important. So insist on meeting the entire team, and also make sure that the team that shows up at the pitch is actually the team that is doing the work. And then if you have a global business, you want a global partner, someone who can access all the potential buyers all over the world. That means in Asia, US, Europe, wherever you are.
And just to be clear, you'd said there earlier about most of these deals you're going to have a retainer plus a success fee, and you were saying not to be careful. It's just a straight retainer where they're just going to bill you for the time as opposed to having a percentage of the outcome, basically, right?
Exactly. I think my business is not selling hours; it's selling successes and results. And I spend months and months on transactions, and they didn't work, and I don't deserve a fee. That's the different business model.
Right.
Very, very clear.
Got it. Okay. And Brett, some thoughts on this?
I think that was great coverage from Rainer. I would say make sure that your advisors have reach. I'm sitting in North America, but I'm responsible for acquisitions globally. And, it has happened where I hear about an acquisition, maybe it's a smaller one or something that's taken place on a bilateral basis somewhere on the other side of the world. And it wasn't even on our radar. And, we may or may not have been a great buyer for that business. And so just try and get yourself out there as much as possible and determine, how your advisors are networked.
Yeah, clearly that Medtech experience absolutely critical there. So let's go do our last structured question, then we'll move into the Q&A. So the last one here is really for David. So let me just bring this one up. So again, and this obviously, representing firms legally is what you do, but just explain the importance of that. And I'll maybe share a couple of thoughts on this too, because frankly, this part saved a deal that I was involved in. So what are your thoughts here? Let's start with David, and I'm going to ask Brett to chime in on this one as well.
Sure. I think certainly from both a buy side and a sell side perspective, it's key from the outset. I think taking it first from the sell side perspective, if you're planning for a sale and doing that key preparation process that Rainer, Brett, and I would have spoke to, having a legal advisor there to actually steer you on that is extremely useful in the sense of working through those kind of customer contracts. Well, where are the gaps? Where do you need change control? Okay, you need to put in a new contract in place with a key employee, whatever it might be, IP registrations, all of that kind of thing. It's key. I think for both sides of the coin, the buy side and the sell side, regardless of whether it's a bilateral deal or a competitive sale process, when it comes to doing the heads of terms, so that's particularly important if it's bilateral. Having legal input at that point in time is key. Now, there's a balance to be struck there. I think when it comes to doing heads of terms, it's very easy to slide into becoming a mini deal within a deal, which isn't the purpose. But by the same token, particularly for sellers, I think it's fair to say it's important to get as much as they possibly can in the heads of terms, and having legal advisors to do that will be key, because that's where you'll be able to get in things around warranties and limitations and warranty and indemnity insurance, non-competes, how it's all going to be reflected. Because what you want to avoid, and it's a temptation to do this, is to just get a heads of terms signed, because then as a seller in your head, the deal's done, brilliant. But actually the deal is what all the strings attached to it are when it comes to negotiating and drafting legal documents. So I think having the legal advisors involved from an early stage is key. And obviously it goes without saying then, as you kind of move up through the process, that becomes even more important in terms of actually negotiating the sale documents and things like that, and obviously diligence and whatnot as well. But I know kind of, Craig, you mentioned you had a couple of thoughts from your own experience on it as well.
Yeah, it just the quality of the firm is so important. Like we were acquired by a public entity out of Austin, Texas, and we actually in the end ended up really out lawyering the public company. Our firm did a better job than their corporate lawyer did, and it really helped get the deal across the finish line. You talked about earnouts earlier. There's another area that's like there's so much risk there for someone selling their business, and you want to make sure the legals are lined up really well there. So yeah, I can't speak to it highly enough. It's a critical part of the process. Brett, from your perspective, any thoughts here?
No, start early. I like that, getting into the heads of terms. Don't be dismissive of risks that you might think are inconsequential, but we generate a red flag report generally as a first pass, and that sort of dictates where we spend our time and how we go forward. And the only other thing I could say is, employment agreements, make sure you give those a lot of thought, because sometimes those aren't considered until the tail end when you're getting very, very close to either the asset or the share sale. But then you've got to go and research, what are the updated employment conditions? What do they look like? And how does that need to progress? And that can take sometimes weeks, because now you're negotiating with employees when they're brought in the fold.
Okay, perfect. So that's the formal questions that we've gone through now. We've got some great questions that came in advance as well, and some that are coming in the Q&A right now. So I'm going to try to hit some of these pretty quickly, and it's a free-for-all here, guys. Just jump in as you see fit. So the first one is around asset sale versus an equity sale. Thoughts on that, pros and cons. Maybe Brett from the buyer side, do you want to talk about that first?
I mean, we're generally quite flexible in terms of asset sale or share sale. I think there's, in terms of tax treatment, it varies from country to country. I guess with the rise in W&I insurance, it's created somewhat of an easier environment for us to have that level of flexibility. But I think, David, you can speak to the specifics of that one.
Yeah, I think that's absolutely right, Brett, in terms of tax treatment then, and I think in terms of legals, undoubtedly asset sales have their challenges. From a buyer perspective, you're effectively cherry picking, and you need to make sure you're getting all of the right bits. Obviously, the counter to that is, well, if you do, you can leave behind risks, which is helpful. By the same token, I think given the nature of a lot of medtech businesses and those, well, generally businesses which are customer heavy, the challenge with an asset sale is the need to then actually move every single contractual relationship over, whereas in an equity sale, those just move part and parcel. So obviously that's something to be particularly alive to, and obviously that depends on the nature of the business as well and who the customers are. For example, if the customers are public bodies and health services, things like that, trying to get those kind of consents to move contracts or get new ones done could be quite protracted and difficult. So I think it just varies from business to business, but as Brett says, the majority of buyers now will be relatively flexible around it, subject, of course, to the tax treatment working.
Well, on that note, there was a question that came in around potential issues of past tax or regulatory issues preventing deals from happening. Maybe do you want to chime in further on that, David? Or?
Yeah, sure. I mean, I think it very much depends on the scale and nature of what those historic legacy issues might be. I mean, obviously, generally speaking, in terms of tax, for example, any historic tax liabilities that are there sit with the seller. So, you're into the realm of indemnities and so forth. And obviously, equally, depending on the nature of that type of tax risk, it's possible to get insurance around that for a buyer, depending on how certain that risk is to materialize. I think with regulatory risk, it's different in the sense of, well, it depends on the nature of the risk, but if it's something that could really morph into reputational damage and therefore value, then that's the sort of thing that could be mission critical to a deal. But if it's, for example, data privacy type breaches and things like that that are relatively discreet and don't go to the heart of the business, then it's the sort of thing where buyers will be able to get comfortable with it through indemnity protection and things like that.
Okay. This one's a sort of a valuation based question. So And it's actually on the merger side, which I mean, obviously we talk a lot about acquisitions, but so this question was, we're looking at merging with another company in a different segment of our industry. I'm assuming a different product segment, probably. We're being told that the combined entity will command a higher multiple than either of the two companies individually. Thoughts and what to watch for. It's the old 2 + 2 = 5, right? So I'm not sure who wants to chime in on that one.
I can start real quickly by just saying it potentially. It does depend on the buyer, though. If you can really lock in some OpEx, I'll say synergy. You've got shared services there, then it could make sense. But conversely, it depends on what segments you're looking at, because if they're too disparate, and the most qualified and likely buyers are a little bit more specialized, they may not like that disparate portfolio. They may not understand the alignment or the strategic direction of that business as well. So those may be fairly obvious, but it can definitely increase the quantum in terms of valuation and give you some more buffer in your margin profile. But the strategy component is going to be a big question mark.
I agree.
Okay.
It really needs to make sense. Maybe one to add. You can fool the potential buyers at the next exit. They are very sophisticated people. Don't expect that you can fool people at exit. So it really has to make sense. If it makes sense, yeah, right. Certainly worth looking into it.
Okay. All right. So this question was more about investments, really, as you're growing your business, you're bringing in investors to grow your business. So I know we talked about this one a little bit before, guys, but please discuss investments and structured deals, why they occur, how frequently, historically, and opinions looking forward. So I don't know, do you want to start that one, Rainer?
Yeah, I can kick off. Yeah, structured deals at the moment are very popular. They are a way to bridge valuation gaps. They are also a way to like solve situations where the owner wants to stay on board, doesn't want to sell 100% of the business. You can do minority deals, and in the current market, in the current financing market, potential investors find it actually quite interesting, because they don't need to go and do a full leveraged buyout, take over 100% and get financing for this. So yes, they structure deals you see now more and more, and I expect that they will stay around for a while, at least until the financing environment is getting back to where we were a couple of years ago. I think on investment, yes, they usually happen on the way. Like when you start a company, at some point you need more capital to grow the business. It's very rare that you're able to finance all of that yourself. So it's normal to get investment over the life cycle of a business. But again, I think be careful, take the right people on, take people on that cannot only provide capital, but also add value. This could be very different, a lot of different things, add value along your way to maybe an IPO, to an exit, or just a successful company that is paying high dividends to the shareholders.
So I'm just looking at time here. There are lots of great questions coming in. I'm going to pick a few of these, and then I'll commit to trying to get answers to the remaining questions, which we'll send in a follow-up with the link to the recording for the webinar today as well, which is what we generally do. We generally run out of time for the live questions because you never know how many you get in advance. We've got lots here today. There is one that I'd like to just bring up with you guys, which is, are acquisitions happening with companies that are still in clinical stage as opposed to having commercialized their products? Are you seeing much in the way of acquisitions taking place in the pre-commercialized stage today? I don't know, maybe Rainer, do you want to?
Yeah, maybe I can take that one. I think in the current environment, it hasn't really changed. I think in medtech, biotech, you see you either get acquired relatively early, or you get acquired when you actually generate significant amount of revenues. You have FDA approval, you have EMA approval, and then everything that comes in between. That's a tough period usually. But when you have the right technology, yes, you may get acquired. At the moment, there is more focus on, let's say, mature companies that have a proven success story, and in particular, large consolidators are very, very picky at the moment when it comes to early stage technologies. And that's like, short story, but I spoke with a head of corp dev at a large company, and he said, like, I rather buy something a bit too expensive than I buy something early stage that doesn't work. I get fired for an early stage company that doesn't work. I don't get fired. I get promoted before we even find out that we overpaid a little bit when a company that is generating revenues.
So I'll just maybe one last one here, and then I'll commit to getting answers to the rest of these. Have the standard processes changed in the M&A space post-COVID in the emerging global market? So did COVID change any of this from your perspective, or not?
From my perspective, we're more maniacally focused on the validity of the financials than we were pre-COVID, just because there's been so much change and volatility. And so it's really tough to figure out exactly what the growth trends really look like. And so there'll be a lot of questions around that.
Okay, so I'm going to just quickly wrap up here. I am going to stay on. If anybody wants to see our platform, I always do this at the end of a webinar. I'll stay on momentarily to do that. I just want to make you aware of an upcoming webinar before I get a chance to thank our panel here. We do have on March 30th, we're partnering with a company called CHG Meridian, which is a German company that provides leasing and financing in Europe and North America in particular in the healthcare industry. Really interesting session about OpEx versus CapEx and tools to help end users, hospitals, clinics, et cetera, acquire your technologies, whether you're a distributor or a manufacturer. So that's coming up on March 30th. Great session. Would love to have people join that as well. I did also say I would include, whoops, my screen's going wonky there. I did say I would include contact information. There we go. So first I want to thank Brett, Rayner, and David. Amazing panel. Really appreciate your time and commitment to this. Again, I can't speak highly enough of my interactions with you, and I would highly recommend all three of you in any circumstance here. Their contact information is there for you. They have shared that. They're willing to take outreach afterwards. As I said, we will send a response as well with some of the unanswered questions. And also just mentioned, sign up for our platform. It's free to join. Would love to have you in there and have a look at it. And I'm going to move into a demo here momentarily. So again, Brett, Rayner, David, thank you so much. Really appreciate your time. Feel free to drop off while I just move in quickly to a demo. Thanks a lot.
Thanks, everyone. Great to talk.
Yeah. Okay, I'm just going to give you a quick overview of the platform for those of you that aren't on it. I know many of the attendees today are already on our platform. But basically is a global platform for helping you navigate markets, find and connect with new partners, and manage your global partnerships, whether you are a manufacturer, distributor, or other stakeholder in the market. So I'll just take about 5 or 6 minutes. I'll give you a quick overview. As I said, you can sign up for free, and certainly you can also sign up for an orientation session with one of our customer care team if you'd like to do that as well. So market discovery is a global view. We cover 105 markets, over 80,000 data points in those markets. So as you look at markets around the world, I should point out first that these green markets are markets that I am currently active in, and the purple markets are my target markets that I'm looking to go to. Our coverage it looks at over 800 data points in a given market. So we look at, in this case, Saudi Arabia, and overview the market, an overview of the healthcare, medical background, how long-term care works, et cetera. And then we cover off a lot of data points like healthcare expenditure and financing, where the money's being spent, where the assets are, hospitals, beds, clinics, even into veterinary, dental clinics, et cetera. And then into employment levels of physicians, clinical specialists, and so on. And all data points are cited and sourced in here throughout this entire area. We cover some healthcare utilization around surgical procedures and diagnostic exams, healthcare indicators and trends, and then lastly, a quick overview of the regulatory environment of that particular market. So in this case, the FDA in Saudi Arabia. So we do that for 105 countries, even though we have distributors in 150 plus countries. And again, as you click on countries around the world, you would be able to drill into those markets and learn about those markets as you go. So that's the first piece, which is market discovery. The second aspect is finding and connecting with new partners, and we do that in two ways. One is a simple sort of look for and connect with potential partners. The other is more opportunistic, which we call opportunity posts, where you identify a specific opportunity, like I want to go to a market like Brazil and I'm looking for distributors, or I'm in Brazil as a distributor and I'm looking for cardiovascular products to sell into my market. That would be done through opportunities. I'll show you very quickly how Find Partners works. It's a very clean, simple way to view the world here. 44,000 now companies profiled here. If I was to, for example, use that first scenario, I'm looking for distributors and or sales agents, and I want to focus on the Brazilian market, you would see 1,137 distributors in Brazil that have cardiovascular products. From there, I could, that's cover all things. If I drill down into cardiovascular products, that 1137 becomes 99 companies. I could become even more specific now, looking at things like market coverage. Are they national? Are they regional? Do they, have they been around a while? What year were they founded? Do they are they specialized, or are they full line distributors, and so on and so forth? I can even look at certifications and registrations that they have in their profile. When you are ready to view a particular company, you can view their quick view. You could view their full profile. You could view their website, their LinkedIn page, and ultimately, when you're ready to connect to that company, you can put in a connection request. They may ask you 2 or 3 questions about yourself, and you could outreach to them and try to start a conversation in myCaribou with that potential partner. Similarly, if you were a distributor, let's say you're in Brazil, you're looking for suppliers of cardiovascular products. So I'm going to now say, show me the cardiovascular manufacturers globally, of which there are 1,458. And I'll show you just that, broken down by country here. And maybe I'm looking for them from specific countries or not from specific countries. So I could say, show me manufacturers out of China, or show me manufacturers that are not out of China. Really up to you how you want to do that. Same idea, you can then connect with potential suppliers. The more powerful way to find new connections with partners, whether it's manufacturers or distributors you're looking for, is through this find opportunities or opportunity post concept. And what we do here is we allow you to post a specific opportunity of something you're looking for. So for example, if I look at this view here, these are all posted opportunities. I'm going to sort it by date. In fact, let's sort it by recency here. So most recent being, this morning, basically. But so here's an example. Here's a company that is a UVC Solutions, which is an EU leader in UVC smart disinfection devices. They're based in Slovenia. They're looking for a distributor in Israeli with national coverage in that market. That is a posted opportunity, and distributors in Israel that fit that get a match score, almost like dating we talked about earlier. My match scores aren't going to be relevant here because I'm logged in as myCaribou. I'm not a distributor or a manufacturer. But my match score, if I was an Israeli distributor of complementary products, would be very high. And in fact, you can just sort and even filter by your match scores. Similarly, you'll see distributors out there that will post an opportunity where they're looking for a particular product. I'm going to give you an example of a great distributor in the United States that focuses on Veterans Affairs hospitals, government, military, and they post regularly opportunities. One recently was for vein viewers, and that vein viewer post then would solicit inbound interest from vein viewer manufacturers that could then connect with that distributor in that particular market. So opportunities are really powerful. You can manage all of your opportunities here. I don't have any currently posted. Creating a new opportunity is dead simple. You give it a title. We give you all kinds of guidance and best practices as to how to do this. And there's all kinds of different scenarios for this. You could even, there are best practices right in here that you can actually have a look at, and we'll even give you some scenarios that you could look at for that. So market discovery, finding and connecting with partners. The third piece we do is partner management. We have a set of tools that allow you as a manufacturer or a distributor or any other stakeholder like market consultants, regulatory consultants, et cetera. It's a tool set that allows you to manage more successful partnerships, because we have found that even if you pick the right partner, execution is still a big issue, and our platform will help you and your partner execute together. So this is my view of the world. Now, whether I'm a distributor and these are my supplier partners, or whether I'm a manufacturer and these are my distributors markets around the world, which is what my scenario is here, that's what this view is all about. So in Argentina, I'm using this distributor. In Australia, I've got these two distributors. In Brazil, I have these two distributors. I can group it by partner or by market. So now think of it as a distributor looking at your suppliers. So if I got a distributor that, for example, that sells into several Eastern European countries, these might be their suppliers, and the countries that they're repping them in could be here as the markets. So group by partner, group by market, either way, incredibly powerful. Now, if I'm there's sort of two aspects to this. One is manage your partner relationships, and the second is collaborate with your partners. You can choose to do both of those, or you can choose to just manage them in here. So for example, in this case, I've identified the various partners that I'm using in each of these markets around the world. If I want to invite that partner in here, so let's use GC Medical in Brazil as an example, okay? I can invite that partner in, and you'll actually see that Marcia has been invited in and can work with me and my team in this collaborative workspace. The things we can do here include discussions, so we can have dialogue with our partner from Brazil in that particular case. We could share files. We can do sales forecasts. We can do business reviews together, quarterly business reviews, for example. We can even do little launch projects. We could have training videos in there. Any number of things we could do together in there. The great thing about doing that is if you invite your partners in, a couple things happen. One, they don't know who your other partners are. So GC Medical has no idea that I'm also partnering with, Biomedica in Argentina. They strictly have access to you as a relationship in here. You, on the other hand, though, can then do things like, let's take a product video as an example. I could say, produce a new little video I want to send out to all my distributors around a particular product. And I could actually send them a message or even share the file or the link to the video directly in here. So you just drop that in there, give it a title. You can choose which of your partners it goes to, which I could have done over here as well. And you simultaneously then are sending out that to all of your distribution partners at a single time. The same thing would be true on the distribution side. I'll give you an example. If I'm a distributor in the Middle East and I'm about to go to Arab Health, I could send out a message to all my suppliers saying, hey, I'm going to be at Arab Health. I'd love to meet with you there, and and so on. You can actually do that right through the platform as well. So there's a lot of power to this. I'll also show you just very quickly the sales forecasting view. As a lifelong business development person myself, I absolutely love this aspect of the platform. High level quarterly sales forecasts that I work with my partners on. It doesn't have to be me and their CRM or them and my CRM or anything like that. It's strictly what do we agree is the target and how are we doing on actuals. I'm doing it at the quarterly level, nice kind of moderate level there to work together. So, again, we just talked about the process of M&A and being prepared. A lot of what I'm showing you here in terms of partner management really would be absolutely critical when you think about acquisitions, selling a business at some point down the road, having your contracts in here, having good sales forecasts, having regular communication with your partners. Imagine being able to bring this up in the due diligence process and explain that you're working with your partners globally in this this fashion. So again, the three key aspects: market view, partnering to find and connect with new partners, and then collaborate with your existing partners. As I mentioned earlier, it is free to join. You can actually even try an opportunity post in your first 30 days as part of that free access. Even if you decide not to subscribe in a paying fashion after the 30 days, you can stay on as a listing in the platform, and you'll actually have people still connecting to you and be able to respond to that through the platform afterwards. So I appreciate all of you that stayed on for that. If you have any questions at all, feel free to reach out. And I want to thank you for your time and appreciate going past the hour here a little bit today. Thanks, everyone. Have a fantastic rest of the day.